This is a production of the Michael Parsons Trading Institute. All rights are reserved. Disclaimer required by the CFTC. If you risk it, you can lose it. ReversalMagic.com presents the Reversal Magic video course. The power to predict, the power to profit. The power to profit. This is Reversal Magic video number 2, Timing Adjustments when Market Interruptions Occur, or what to do when the market gaps and when holidays or weekends occur. As we saw in the previous DVD, Reversal Magic is an extremely powerful tool for trading. But it is a timing method of trading, and therefore the timing must be accurate. Now, while typically accuracy is not an issue, there are variables within a market that can impact the timing and require adjustment. Most of these can be anticipated for and the adjustment made in advance before the reversal actually occurs. So typically it's not an issue as long as you make the adjustment. But understanding what adjustments to make and how to make them is a fact that we need to understand in order to avoid any problems. Well, suppose we're looking at this market dropping here, and rather than this bar here, which is low, we have a reversal signal indicated here. Well, obviously we would have missed out a considerable amount of profit as the market rose higher. Or perhaps on the other hand, we're looking at this reversal here, but instead our signal indicates this bar. Obviously we would have missed out not only a profit, but also had to deal with a drawdown that may in fact cause us to jump out of the market, taking a loss and missing out on the profit as it finally makes its move to a lower position. These things are rather important consideration when making a trade, and they can impact your confidence in Reversal Magic. So it's important to understand how to make these adjustments when they are necessary. Now, what variables will impact the market so that adjustment is necessary? These things include market gaps, holidays, and sometimes even weekends. There are a number of factors involved, but all of them are predictable and can be accounted for in advance. Consider this market, which is the Japanese yen, and this is the pit and electronic charts combined. What if we switched over to just the pit trading? What do you see? Well, you see quite a contrast from the chart that we just showed you, and yet it's the same market. Only this is just the pit trading rather than the electronic as well. You'll see highs and lows that simply do not match, and many gaps in this market that create a variable. Does that mean that the reversals or signals that we generate off this chart will be in stark contrast to the other chart? Not necessarily. If we know how to make the adjustments, we can end up with the exact same time from one chart to the next. Now that seems quite a stretch, but that is the case when using the adjustments as they are necessary. So what are these adjustments and how do we determine how to make them? Well, we're going to start by looking at the first issue of the timing, and that is having to do with gaps and how they impact the timing of reversals. Gaps and trading interruptions will offset the timing of reversals. Many times a market will have or exhibit things that are out of ordinary for it. For example, in this, the S&P E-mini, you'll see at times in the daily time frame, the market will jump or gap in price level. These gaps do impact the timing of the market in using your reversals, and so they have to be considered. Other interruptions that will impact the timing are holidays and market shutdowns because of different reasons, such as news events, or the market has moved too quickly, too fast, and the market stops trading. In any event, these things need to be considered. Though not that frequent, they do play a role in impacting our decision as to where to set the timing of a reversal. However, that's not to say that every gap is important and will alter the timing of reversal. Many times, gapping is nothing more than an issue of low participation, such as this market, which is cocoa. On an individual contract, you will see many gaps exhibited in the market. Yet these gaps have little impact and are only a matter of the market, because of low participation, trying to keep up with the front month that does have higher participation. If you look at it, the question is a simple matter of asking, have these gaps impacted the timing or not? And the answer is simply determined by determining a reversal and seeing the end result. For example, here we can determine a reversal, and lo and behold, When we set in place, we find that it's accurate, meaning that these gaps had no impact on the timing whatsoever. So in a case or situation where market has gapping because of low participation, you can ignore this and treat it as if they never occurred. Additionally, longer-term time frames, such as monthly charts or weekly charts, it's best to ignore gaps and market interruptions and not make any adjustment at all. For example, this cocoa chart, which is set at a weekly time frame, has within it gaps and, of course, market interruptions that occurred throughout the year. Despite that fact, when we determine a reversal, we still end up with a very accurate determination. For example, these two lows combine with this high and this high. And what do we get? Well, we get some nice reversals to work off of. A great low here and a great high here, despite having a gap in the market. So longer term time frames, these gaps and market interruptions can be ignored. Every triangle has three sections to it. Once you determine a reversal, you may find, though, that somewhere between the first point and the actual reversal, there's a gap somewhere within that triangle. How do you handle that, and how does it impact timing? Well, by looking at the actual triangle and dividing it into sections enables us to know how we should move the actual timing of the reversal to the appropriate location. So let's examine a triangle and divide it into sections. Picture for a moment a seesaw. Now, a seesaw is nothing more than a long board that has a central point of pivot. Typically, the board is centered right on that pivot location so that it will balance itself even without weight. Add any weight to one side or the other, and you impact how that board will tilt. Add more weight to one side, and that side will tilt downward while the other side tilts upward. This difference or rotation caused by an increasing amount of weight is a principle that we can use in determining how to adjust for gaps. Let's see an example. Let's consider the possibility of a gap in the center of our triangle. If we go to the principle of our seesaw, if we place the weight right in the center of that seesaw, well, it's just going to maintain the balance of the seesaw. This principle applies in regard to our triangle. Remember that we have a center to our triangle that runs from the second point, which is where the horizontal line is taken, and the last point that we use to draw a triangle. This is considered our center, and if there's a gap in this location, in this section, well, then it's centrally located and therefore will not require an adjustment on the timing whatsoever. The timing, as indicated, would remain the same. What if we happen to find a gap within the left-hand section or right-hand section of the triangle? What then? Well, going back to our seesaw, if we have a weight that occurs on the left-hand side but not on the right, what happens? Well, it creates an imbalance. The board goes down on the left-hand side. To return that board to balance, we'd have to add a weight to the right-hand side. Of course, in the markets, we're not dealing with weights, but rather time. So for each gap that occurs on the left-hand section, we would have to move the timing one to the right. To show you exactly what that means, let's go back to our triangle. And if we have a gap that occurs on the left section, which is actually the first point that we would use for the triangle, to the second point where the horizontal line is taken from, then for each gap we would move the timing one to the right. If one gap occurs in the section, rather than the timing indicated, we would go one bar later to indicate when the time will occur. If we have two gaps, well, then we would move it 2 bars as the indicated timing. If we have 3 gaps, then we would move it 3 bars later to balance out the difference. In like manner, if we find that there is a gap in the right-hand section of the triangle, then adjustment is necessary also. But in this case, rather than later, it would be earlier. Going back to the illustration of our seesaw, if we added a weight to the right-hand side, obviously we're going to create an imbalance. To balance this back out again, we have to add a weight to the left-hand side. Or in the case of timing, move the timing 1 bar earlier for each gap that occurs. Looking at our triangle, If we have a gap in our right-hand section, which covers the time from the last point we used to draw the triangle to the actual reversal time, then for each gap that occurs, we would move it one to the left. We have one gap, well, rather than the timing indicated, we move it one earlier. If we have two gaps, then we would move it two earlier, and so on, adjusting the timing accordingly to balance it out. But what if you have gaps on both the left-hand and right-hand side of the triangle? What then? Well, let's go back to our illustration of the seesaw and consider what would happen if we have a weight on the left-hand side and right-hand side. If they're similar in number, what happens? Well, they tend to balance one another out and, in fact, cancel the impact they would have. The same thing is true in regard to gaps in a triangle. If you have the same number of gaps in the left hand as the right hand side, well, they will cancel each other's effect and maintain balance. No timing adjustment will be necessary. But what if you have more on one side than the other? What happens? Well, for example, here, if you have 2 on the left-hand side as opposed to 1, there is definitely an imbalance. To correct that, you would have to make an adjustment to the right. 2 minus 1 is, in fact, 1, requiring one adjustment. So, in this case, a move to the right by 1 would be necessary. How does this apply in regard to our triangle? Well, let's examine this. If we had one gap on the left-hand side and one gap on the right-hand side, well, they balance one another out, and therefore no adjustment to timing would be necessary. However, if we had 2 on the right-hand side as opposed to 1 on the left, then we have 1 too many on the right, and it has to be adjusted or changed 1 earlier than what it was originally indicated. If, on the other hand, we have 3 on the left hand compared to 2, well, now we have 1 too many on the left-hand side to the 2 on the right, and so we would have to shift it 1 to the right. If we had 4 on the left and 2 on the right, then there would be a difference of 2, and so the timing would have to be shifted not 1, but 2 bars. So it's a matter of the difference between the two that would determine in which direction and how far you would move the timing. Just as gaps impact the timing of reversals, so do holidays. If you're trading a daily chart and have market interruptions that are out of the ordinary, such as holidays, then adjustment would be necessary. Unlike gaps, the adjustment for holidays or market interruptions are much easier. It doesn't matter where the holidays may fall within the triangulation, you simply add to the time. In this case, we have a reversal indicated right here. Now, this is near the top and looks pretty good, but it's certainly not the perfect point of entry to short this market. That would be here with the highest bar. You note that there are 3 bars separation. What made the difference? Well, if you go back here, you would find that December 25th and 2 days in January create 3 holidays in the market, requiring that an adjustment be made. No matter where those holidays fell within this triangle, we would simply add additional days. In this case, 3 days later, 1, 2, 3, and we come up with exactly the right time. As simple as that. You don't have to worry about where that holiday falls as you do with the gap. Just simply add to the market or the time in order to come up with the correct time for the reversal. If by chance your chart system provides the opportunity to show an empty bar where a holiday would occur, then you can avoid this altogether, because what happens is that by adding the empty spaces, you actually create a triangulation that is accurate and correct, with no adjustment required. Although gaps have the inconvenience of requiring you to adjust your timing, they do provide an added bonus or benefit, in that they can be used as substitute points for determining reversals. Anytime you have gaps, well, there are significant wave breaks, and if you determine a reversal off of them, they will tend to provide significant signals. How does it work? Well, let's take a look at this particular gap right here. This gap has both a lower end and upper end of range of the gap. Both could be used to determine a reversal. So we're not just talking about one reversal signal, but rather 2. Simply taking a prior high or low, take it across the lower end of the gap and create a diagonal line. Do the same thing with the upper end of the gap, creating a second line. And then simply add your horizontal line to triangulate and thereby provide the signal for the reversal. What you end up with is a significant reversal where the market moves substantially off the price level. In this market of soybeans that tends to provide erratic moves, knowing that the market's going to reverse at these particular points is of course significant. The added bonus of using a gap to determine reversals is that even though there are other gaps in the market, there is no adjustment required. The reversal based on a gap has a tendency of not requiring any adjustment whatsoever when it comes to dealing with other gaps. This is quite different than the normal procedure of using a high or low, but it does make it much easier. The only adjustment that would be required is if a holiday occurs that your chart does not compensate for. For each holiday, then you simply follow the same rule as before. You would move it one bar later for each holiday that occurs within the triangle. So the gaps do provide a significant bonus or benefit. One other issue we want to deal with in regard to gaps and adjusting for timing is the issue of gaps that are produced by nothing more than low participation. Such gaps can be ignored. An example can be seen in this contract, which is the British pound. You'll note that during this period of time there are a lot of gaps that do occur, yet later on the market fills out nicely and has little or no gaps occurring. What's the difference? Well, this contract during this period of time back here was in the front month. In fact, another contract was in play and had the most attention and of course the most traders. The activity here was nothing more than the market trying to keep up with that market that was highly participated. As that contract expired and this one took over, well, then it started to fill in nicely and everything returned to normal. These gaps created here are because of low participation, nothing more, and therefore they can be ignored. Now you might ask yourself, well, now that creates an element of confusion. Here I have some situations where I'm going to adjust for gaps and other times when I'm not. How do I do that? Well, it really comes down to one simple issue. How do the reversals respond when you determine them? If you look at the gap area and determine a reversal, what do you come up with? For example, I can determine a reversal right here off these two lows and this high. And what do I end up with? A reversal right on time. Obviously, these gaps did not impact the accuracy of that reversal. I can even do more. For example, I can take this low and determine a reversal with this low and this high. And what do I come up with? Again, with a reversal right on time. I can even take this low and triangulate it with this low using this high. And what do I come up with? A reversal right on time. You see, none of these gaps impact any of these reversals, and so they can be ignored. So simply by looking at the prior reversals and determining if they were impacted by these gaps, you can know for sure and verify whether you need to make an adjustment or not. It's as simple as that. And finally, we couldn't leave the issue of market timing adjustments without considering new wave formation. You see, we're using a wave analysis technique, and we need to have the waves already in the market in order to determine accurate reversals. But in the real world, in the real markets, new waves do form all the time. And if they're strong enough, well, the impact will be seen by inaccurate reversals. An example of this can be seen right here, where we see this very quick, sudden move. The market had been making a steady pace, but then a report came out, and the market reacted positively to this. A new wave formed. Now, this is not just a small, simple move, but an extreme move in a very short period of time. It is outstanding in the particular market that we're looking at. It is typically followed by consolidation. The consolidation serves as a means for the market to absorb that new wave. And by the time the consolidation breaks out, well, the reversals tend to be accurate once again. Even in the consolidation, typically the reversals will start to become accurate, but initially, at least the first few points, will tend to be inaccurate, and you need to be aware of that. To give you an example of what I'm talking about, let's take these 2 points and determine a reversal using the high. Now these are all 3 good strong points, but what kind of reversal do they provide us? Well, it's kind of an in-between point between this high and this low. Not much value. So as a reversal, it's really inaccurate. And this is quite common with a new wave. Now fortunately, this scenario typically happens within a consolidation, a market condition that a trader usually doesn't want to trade anyway, so you're not missing much. But the fact is, it does make the point stand out that, well, the reversal is inaccurate, and that needs to be considered. Allow the market time to absorb that, and guess what happens? The accuracy returns back to the way it was before. In fact, I can use one of the lows that I used as well as the high I used before, and suddenly I end up with an accurate reversal, as you see right here. So by the time a consolidation breaks out, well, the accuracy should have returned to normal. But even before then, somewhere within the consolidation, particularly if it's long enough, the accuracy returns. And if you want to start using the reversals earlier, then simply look for evidence or signs that the accuracy has returned. For example, I can use these 2 points in this high, and I end up with a reversal right here. Now, while this is not a dramatic reversal, it is clear that it's going up to a high and then start to decline off of that. So it is an accurate reversal. In any event, the key is that you want to remember that in an extreme move that's out of the ordinary for a market that comes to a sudden screeching halt and then forms a consolidation, well, typically that is a new wave formation, and therefore you keep in mind that initially the reversals will probably be inaccurate. Either wait for the consolidation to break out, or wait till you see signs of accurate reversals occurring. By doing so, you'll certainly avoid any problems that you may have otherwise. This completes Reversal Magic training video number 2, Timing Adjustments. This is a production of the Michael Parsons Trading Institute. All rights are reserved.